Imagine for a moment that the entire world depends on a single current, one river of value flowing through every economy, every trade, every transaction. What happens when that river shifts its course? What happens when tides rise, when confidence erodes, or when new streams begin to form elsewhere? The truth is, history has shown us, again and again, that no currency remains supreme forever. Power moves in cycles, value migrates. Innovation redefines what money even means. We are entering an era where relying on one currency, one system, or one central authority of value is not just risky, it's novelty. The global economy is rewiring itself. Nations are diversifying reserves. Investors are searching for alternative stores of value. Technology is building bridges that bypass the old monetary gates entirely. Yet, many still stand still, assuming the past guarantees the future. That assumption has cost generations before us, and it will cost those who don't adapt now. Caution is not fear, it's awareness. Currencies, like empires, carry the illusion of permanence. They seem immovable until they're not. Look back. Every dominant currency in history, from the florin to the pound to the dollar, reached a point of saturation. Overconfidence sets in, debt piles up, and innovation shifts elsewhere. The signs always appear long before the fall, but few choose to see them. Today, with inflation oscillating, debt ceilings rising, and policy tightening across major economies, the signals are flashing again. The structure of global finance is being challenged, not by revolutionaries, but by innovation itself. Decentralized systems, digital assets, and cross-border payment technologies are quietly rewriting the rules of exchange. Whether people accept it or not, the definition of safe is evolving. Relying on one currency is like relying on a single engine in a turbulent sky. When it works, it feels effortless. When it stalls, the descent is fast. Balance is not just smart, it's survival. True investors, true builders of the future, recognize that value today is dynamic. It moves faster than regulation. It responds to technology before policy can even react. And that is where the opportunity lies, not in fear, but in foresight. Across emerging markets, we're witnessing quiet revolutions. Countries experimenting with gold-backed settlements, digital trade ledgers, and bilateral agreements in non-dollar terms. What once sounded radical is now pragmatic. The conversation is shifting from if to when. This isn't a rejection of one system, it's the rise of many. And that plurality of value is what will define resilience in the next decade. But this evolution isn't just geopolitical, it's psychological. We've been conditioned to measure all things against one benchmark, one reserve, one authority. Breaking that mindset is the first step toward real financial independence. Diversity of thought must come before diversity of assets. When investors begin to think beyond a single monetary anchor, they unlock the freedom to evaluate opportunities without inherited bias. We are watching a historic rebalancing unfold. It won't happen overnight. Transitions of this scale take patience, vision, and courage. But they always start the same way, with individuals and institutions realizing that concentration, not volatility, is the real risk. The world's financial ecosystem is evolving from centralization to circulation, from dependence to optionality. Those who embrace this shift will not just protect their wealth, they will participate in shaping the new foundations of global value. So, when someone asks whether it's safe to keep everything tied to one currency, the answer isn't about safety. It's about perspective. Safety lies in adaptability. It lies in the ability to see what's coming before it becomes obvious. History rewards those who act on truth before consensus forms. The future will not belong to the ones clinging to the past, but to those building new paths for capital to flow. Every major transformation, from gold to paper, from paper to digital, has rewarded the curious, not the complacent. And now, as we stand at the edge of another transformation, the same rule applies. The world is telling us, in its own quiet way, to diversify not just our portfolios but our perception of money itself. Because when you stop relying on one currency, you start relying on something far stronger: your vision, your conviction, and your capacity to adapt. And in a world that's constantly changing, that adaptability is the only currency that never devalues. There's a quiet shift happening beneath the noise of markets and headlines. one that separates illusion from reality, digits from depth, speculation from substance. We live in a world where value has become abstract, where assets flash across screens, where ownership often feels like a number in a database rather than something tangible, grounded, or enduring. But in times of transition, when confidence in paper, promises, and code is tested, the world remembers a timeless truth: what's real lasts. Owning real things has always been the foundation of resilience. It's not just about owning property, gold, or land. It's about anchoring your wealth in assets that serve human needs and stand the test of time. When systems shake, currencies fluctuate, and valuations distort, real assets remain. They carry utility, scarcity, and permanence. They are the counterbalance to uncertainty. Think about what the last decade has taught us. As liquidity flooded markets, asset prices soared. Yet that very abundance of money diluted meaning. Value inflated faster than fundamentals. People began trading abstractions, layers of leverage built on top of speculation, detached from anything physical or productive. It worked, until it didn't. The moment the tide of liquidity receded, the truth became visible: only the real things remained. In every financial cycle, there comes a moment of reckoning, a point where investors rediscover the difference between ownership and exposure. Exposure is fleeting, ownership endures. Exposure can be turned off with a click. Ownership must be held, maintained, and believed in. When you own real things, whether it's productive land, innovation-driven companies, commodities, or infrastructure, you own participation in the physical and creative fabric of the economy. You're not just betting on sentiment, you're tied to substance. But owning real things is not about nostalgia or returning to the past. It's about aligning with the next era of productivity. The world is rebuilding: energy systems, supply chains, data networks, transportation grids. The most valuable assets of the future will combine the tangible with the technological. Real doesn't mean old-fashioned. Real means essential. The assets that power our world, feed our cities, connect our lives, these will define enduring value. For investors, this requires a mental shift. For years, the market rewarded speed over solidity, narratives over numbers. But as rates rise and liquidity tightens, gravity returns. Cash flow, cost of capital, material scarcity, they matter again. The age of infinite expansion is giving way to an age of discernment, where the question is not, what's trending, but what endures. There's also a psychological comfort in owning something real. In uncertainty, the human mind seeks tangibility, something it can touch, measure, or see. That's not irrational, it's instinct. Real assets provide grounding. They remind us that value is not created by hype but by function. The house you live in, the land that feeds you, the metals that build your infrastructure, the companies that produce real goods. These are more than lines on a chart, they are civilization's scaffolding. Yet, the irony is that true ownership is becoming rare. In an age of derivatives, debt, and digital representations, fewer people actually own what they think they own. They own claims on claims, not the asset itself. That's why the coming decade will reward clarity over complexity. Investors who seek real exposure, who can point to the tangible backbone of their holdings, will be the ones who withstand volatility. Real things don't vanish with policy changes or digital glitches. They can't be printed, replicated, or coded infinitely. Their value is anchored in physics, not opinion. That's why when systems break or currencies weaken, capital rushes back to what's real. It always has, and it always will. But beyond profit and protection, owning real things is also a form of integrity. It's aligning your wealth with what you understand and believe in. Something that contributes to human progress, not just to price movement. It's a quiet vote for authenticity in a world chasing illusion. And when you think about the future, the next 10, 20, 30 years, it becomes clear those who build, produce, and own the tangible foundations of value will define the next wave of prosperity. Because no matter how digital the world becomes, energy will still need to be generated, food will still need to be grown, metals will still need to be mined, and homes will still need to be built. The digital world may amplify opportunity, but the real world sustains it. True wealth is not in what fluctuates, but in what functions. Not in what trends, but in what endures. So, as markets twist and narratives change, remember this: in every cycle, truth returns to substance. Own what is scarce. Own what is useful. Own what the world can't live without. Because in the end, owning real things isn't just a financial strategy, it's a philosophy of resilience. It's a commitment to reality in an age of illusion. And reality, no matter how turbulent the world becomes, never goes out of style. When the world feels uncertain, when markets move in unexpected directions, when narratives shift overnight, the instinct is to seek safety in what feels familiar. But true safety rarely lives where everyone gathers. It lives in diversification, not as a cliché or checklist, but as a deep understanding that no single idea, sector, or asset class owns the future. The world is too dynamic, innovation too disruptive, and human behavior too unpredictable for concentration to be wisdom. Diversification is not hesitation, it is foresight. It's the quiet discipline that keeps you alive long enough to benefit from conviction. For decades, investors have chased simplicity: one index, one currency, one region, one narrative to believe in. But history has never rewarded narrow bets. It rewards those who balance conviction with humility, who recognize that even the strongest thesis is still vulnerable to the unknown. Diversification is the admission that we can be wrong and still win. It is a system of survival, not surrender. Think about how innovation itself evolves. Every breakthrough begins as a single idea, fragile, unproven, full of potential, but it only reshapes the world when surrounded by complementary technologies, new markets, and supportive ecosystems. The same principle applies to investing. One asset can succeed, but true transformation requires many forces working together. The electric vehicle needed batteries, semiconductors, logistics, software, and time. Diversification mirrors that complexity. It reflects how progress itself unfolds, through variety, connection, and adaptability. We live in an era of convergence where energy, technology, biology, and data are blending faster than ever before. In such an environment, concentration is risk. A single policy, innovation, or geopolitical shock can ripple through markets, erasing years of returns in days. The antidote to fragility is balance, holding assets that respond differently to stress, that thrive under different conditions, that don't all depend on the same outcome. But diversification is not simply spreading capital across many things. It is intentional design, building a portfolio that breathes with the world's complexity. It means owning exposure to different forms of innovation, to various geographies, to multiple monetary systems. It means seeing protection not as hiding from volatility, but as harnessing it, using variety to turn chaos into resilience. Some mistake diversification for a lack of conviction, but the opposite is true. It takes deep conviction to stay flexible, to believe strongly in the long-term direction of progress, yet humble enough to admit that its path will twist. Conviction without diversification is ego. Conviction with diversification is endurance. The future rewards those who prepare for multiple scenarios, who understand that progress is not linear, that cycles repeat, and that innovation often surprises even its most devoted believers. In times of monetary tightening, diversification protects purchasing power. In times of inflation, it shields real value. When one region faces political risk, another provides stability. When one industry matures, another is just being born. The world's energy is always shifting, and diversification lets you move with it rather than against it. Look deeper into the structure of global capital today. It's evolving just as technology is. We're watching the decentralization of finance, the rise of new asset classes, new currencies, new forms of value. In such an environment, holding all your faith or your wealth in one place, one system, or one idea is no longer prudence. It's exposure. The strongest portfolios of the future will not just balance sectors or regions, but balance eras, the old economy with the new, the physical with the digital, the centralized with the decentralized. Even in innovation, cycles of hype and disillusionment repeat. Diversification ensures participation without devastation. It lets you stay invested through the noise, because when one wave crashes, another begins to rise. That rhythm has always existed in markets. Growth follows fear, Decline follows euphoria, and progress continues regardless. The diversified investor doesn't try to time that rhythm, they dance with it. At its core, diversification is humility disguised as wisdom. It's the recognition that no one knows everything. Not central banks, not governments, not investors, not algorithms. The future belongs to those who can absorb shocks without losing direction. It's not about avoiding risk, it's about engineering durability. And in a time when volatility feels like a constant, when policy shifts redefine entire industries overnight, when global alignment fractures into new blocks and new currencies, diversification is not optional, it's essential. It is the shield that allows conviction to survive. Because the truth is, no one knows which innovation, which country, or which system will lead the next chapter of growth. But by owning a mosaic of possibilities, by spreading exposure across what is proven and what is emerging, you ensure that progress, wherever it appears, works for you rather than against you. In the end, diversification is not a defensive move, it's an offensive strategy for longevity. It's the art of staying in the game long enough to see your beliefs play out. It's how vision meets realism. It's how conviction learns patience. And in a world that rewards adaptability more than certainty, diversification remains the most powerful form of protection. Not from the future, but for it. Every generation believes its moment is different, that the volatility it faces, the innovations it witnesses, the fears it endures, are somehow unprecedented. Yet if you step back, if you zoom out beyond the noise, you see the rhythm of history repeating in patterns. Economies rise, peak, reset, and rise again. Innovation disrupts, then stabilizes, then disrupts once more. Markets swing between fear and greed, confidence and doubt, expansion and contraction. The world doesn't move in straight lines, it breathes in cycles, and those who learn to think in cycles, not headlines, are the ones who stay standing when others stumble. Thinking long-term is not simply holding on to investments for years, it's understanding the rhythm of progress itself. It's realizing that downturns are not the end of growth, they are the beginning of renewal. Every major breakthrough, every enduring wealth creation story, emerged from moments of skepticism, volatility, and temporary decline. But the majority rarely see it that way, because emotion blinds perspective. The short term dominates the narrative, while the long term quietly defines the outcome. Cycles are nature's way of recalibrating. They cleanse excess, expose fragility, and make room for innovation. In finance, they remind us that capital chases stories until reality catches up. In technology, they remind us that hype fades but progress continues. And in human behavior, they remind us that patience is not weakness, it's strength. When you think long term, you begin to see corrections not as chaos, but as part of a grander pattern of renewal. Every major economic transformation, from the Industrial Revolution to the digital age, began with a period of creative destruction. Old systems broke down so new ones could emerge. What looked like collapse was, in hindsight, the groundwork for a new era. The same dynamic plays out today. The noise of policy changes, interest rate cycles, and political uncertainty often distracts from the underlying current technological progress that refuses to stop. The future doesn't move backward, it pauses, it consolidates, and then it accelerates again. The challenge for most investors and thinkers is emotional time compression, the inability to see beyond the next quarter, the next rate decision, the next crisis. But the greatest opportunities appear when time expands, when you can imagine what the world might look like 5, 10, 20 years ahead. The longer your perspective, the clearer the patterns become. Markets reward patience the same way nature rewards endurance, slowly but inevitably. To think in long-term cycles is to detach from the illusion of permanence. Booms don't last forever, and neither do busts. Both are part of a healthy ecosystem that moves capital from weak hands to strong ones, from outdated ideas to emerging ones. The short term is about survival. The long term is about evolution. Every innovation, every market leader, every economic expansion was built by those who could tolerate the discomfort of uncertainty and still keep building. When you analyze the past century, you see a rhythms. Innovation leads growth, speculation amplifies it, debt overextends it, crisis resets it. and innovation begins again. That's not a flaw, it's the engine of progress. If you understand that pattern, you stop fearing recessions. You start preparing for what follows them. Because what follows contraction every time is creation. The long-term thinker is not a dreamer detached from reality. They are a realist who understands that cycles are reality. They don't measure success by monthly returns, but by the direction of compounding ideas over decades. They don't panic when markets fall, they accumulate. They don't chase euphoria when markets rise, they rebalance. Their edge isn't prediction, it's perspective. Patience in this age is a radical act. Algorithms, media, and speculation all push us toward immediacy. Instant data, instant reaction, instant judgment. But the world's greatest wealth, both financial and intellectual, has always been built on delayed gratification. Thinking long-term doesn't mean ignoring the present, it means not being consumed by it. It means asking, what is the cycle teaching me now? What excess is being purged? What opportunity is quietly forming while others panic? The truth is, cycles are not obstacles to avoid, they are guides to follow. They show where confidence is misplaced, where value is mispriced, where the next wave of innovation is incubating. When you start to see the world through that lens, volatility stops being noise. It becomes information. It tells you when to lean in, when to step back, when to wait. And so, thinking long-term is less about predicting the future and more about aligning with its rhythm. It's understanding that every era of uncertainty carries within it the seeds of the next expansion. The markets don't punish patience, they test it. They don't reward speed, they reward endurance. The long-term cycle thinker stands apart not because they know what will happen tomorrow, but because they trust what happens over time. They understand that growth is not linear, that innovation compounds quietly, and that faith in progress, even through downturns, is what separates the visionary from the reactionary. When you step back and see the arc of history, you realize that time is not your enemy, it is your greatest ally. Everything meaningful, discovery, innovation, wealth, impact, unfolds across cycles. The key is not to escape them, but to understand them. Because once you do, every crash becomes a setup, every storm a clearing, and every ending the beginning of something greater.